Throughout the 1980s and early 1990s, East Asian economies experienced rapid, sustained industrial expansion. Annual growth rates frequently exceeded 8%, transforming primarily agrarian nations into global manufacturing hubs in less than a generation. This chart plots the engine of that growth, private foreign capital flowing into the region. Between 1994 and 1996, net private inflows more than doubled, surging to $93 billion, as global investors sought high returns in the booming Asian markets. But this aggressive expansion was built on highly vulnerable infrastructure. Local governments and corporations were accumulating vast amounts of foreign debt to maintain their growth trajectories. The sheer volume of incoming cash kept the economies flush with liquidity, which masked deep structural weaknesses in their banking systems. As long as the capital flowed in, the flaws remained hidden. Three specific mechanisms created this vulnerability. First was the currency peg. To attract foreign investors, Asian central banks fixed the exchange rates of their local currencies directly to the US dollar. This manufactured confidence by removing the risk of exchange rate fluctuations. That guarantee attracted massive amounts of hot money, short-term loans from foreign banks. Because it was short-term, lenders could demand this capital back immediately at the first sign of trouble, placing immense physical strain on the local economies to maintain dollar reserves. Inside the borders, this capital met a system of crony capitalism. Poorly regulated domestic banks routed billions in loans to the friends, family members, and favored corporations of political leaders, completely bypassing normal risk assessments or business health checks. The fixed exchange rate, the reliance on short-term foreign debt, and corrupt lending practices constructed an economy entirely dependent on momentum. It required continuous, uninterrupted injections of foreign dollars just to service the existing debt. Thailand became patient zero. Local businesses utilized billions in foreign hot money, fueling a massive commercial real estate bubble in Bangkok, building high-rises far beyond actual market demand. When the local market saturated, the bubble burst. Developers defaulted on loans, leaving the Bangkok skyline littered with the concrete skeletons of unfinished, abandoned towers. Foreign investors evaluated the real estate collapse and realized their loans were deeply at risk. Panic set in, and they immediately demanded their hot money back. To pull their money out of the country, investors aggressively traded their Thai baht for US dollars. This massive sell-off created immense downward pressure on the value of the baht. To protect the currency peg and keep the baht's value stable, the Bank of Thailand was forced to step in. They spent their own national reserves, selling US dollars and buying baht, to absorb the panic. On July 2, 1997, the Bank of Thailand completely depleted its dollar reserves. Without the dollars to defend the exchange rate, the government was forced to abandon the peg. Floating on the open market and subjected to massive selling forces, the Thai baht immediately collapsed in value. This single policy shift instantly evaporated the purchasing power of the nation. Local businesses, which generated revenue in devalued baht but owed debt in strong US dollars, were trapped in loans they now had no mathematical way to repay. What happened next was financial contagion, a psychological chain reaction where panic in one market directly infects investor behavior in others. This map traces the path of that contagion. Investors realized that the Philippines, Malaysia, and Indonesia utilized the exact same economic model as Thailand, hiding the exact same corporate debt problems. Up to this point, investors had been blinded by moral hazard. During the 1995 Mexican peso crisis, international agencies bailed out the debt. Lenders assumed Asian nations would receive similar rescues, erasing their perception of risk. But when they realized a bailout would not save their Thai assets by shared vulnerabilities and foreign debt profiles, a localized real estate bust in Bangkok triggered a synchronized continental financial meltdown. The contagion eventually reached South Korea, an industrial giant that collapsed due to the structure of its own corporate landscape. The South Korean economy was dominated by the chaebols, massive, family-owned business conglomerates that controlled heavy industries, from shipbuilding to electronics. As this diagram illustrates, the chaebols contained a fatal flaw. They operated on massive leverage. At the time of the crisis, the 30 largest chaebols averaged a 330% debt-to-equity ratio, meaning they owed more than 3 times their actual value. When foreign capital fled and the national currency dropped, the central bank was forced to raise interest rates drastically. The chaebols could not service their massive debts at these new exorbitant rates, triggering corporate bankruptcies and mass layoffs. South Korea proved that industrial production capacity offers no protection when a nation's corporate sector is built entirely on toxic leverage. Indonesia suffered the most severe economic and human devastation of the crisis. Its banking system was highly fragile and deeply intertwined with political corruption. Power rested entirely with President Suharto. Much of the nation's industrial policy was explicitly designed to ensure that investment funds enriched his direct family and political allies. When the crisis hit, the mathematical devastation was absolute. The Indonesian rupiah lost roughly 80% of its foreign exchange value. Because Indonesia imported essential goods, the cost of food and survival materials skyrocketed overnight. Items affordable one week were mathematically out of reach the next. The collapse of the rupiah bypassed corporate balance sheets and directly targeted the civilian population, turning a banking failure into an immediate hunger crisis for millions. Fearing that the Asian meltdown would trigger a cascading failure across the global financial system, the International Monetary Fund stepped in to intervene. Looking at this table of emergency commitments, the scale of the rescue was massive. The IMF organized $17 billion for Thailand, and a staggering $57 billion for South Korea to inject liquidity back into their central banks. But the capital came with strict, mandatory conditions. They had to raise interest rates, slash government spending, and close insolvent banks. These policies drew intense criticism. By forcing interest rates to sky-high levels to defend the currencies, the IMF created a severe domestic credit crunch that bankrupted perfectly healthy local businesses that simply needed operating cash. The international intervention successfully halted the systemic risk to the global markets, but the prescribed medicine inflicted deep, lasting economic pain on the local populations. The human cost of the resulting recession was staggering. Millions of workers lost their jobs simultaneously. In Indonesia alone, the total economic output contracted by 14% in a single year. Extreme economic desperation quickly evolved into political revolution. In Jakarta, the collapse of living standards sparked widespread riots and property destruction, ultimately forcing President Suharto to resign after decades of continuous rule. Across the region, labor forces mobilized. In South Korea, organized workers actively protested the mass layoffs and demanded their government reject the harsh austerity measures imposed by international creditors. When massive corporate debt is rapidly shifted onto the shoulders of the working class, severe economic contractions inevitably result in direct political instability. The acute phase of the crisis eventually broke. By 1999, the affected nations initiated a slow recovery by actively cleaning non-performing loans off their bank ledgers and pivoting heavily toward manufacturing exports. The events of the 1997 crisis proved that in a digitally connected global economy, massive volumes of unregulated capital act as a destructive force when they rapidly exit an emerging market. Following the crash, central banks across the developing world radically altered their strategies. They began hoarding trillions in US dollar reserves to ensure they would never again be caught defenseless against sudden capital flight. The Asian financial crisis established a permanent boundary for modern economic development. No period of rapid growth can endure if its foundation requires masking long-term structural liabilities with short-term foreign debt.